Hi there, my name is Jason Ayers, Director of Business Development with the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our monthly review and commentary for March 2019. Having broken records to the downside in the fourth quarter of 2018, Canadian and U.S. stocks turned the tables so far in the first quarter of 2019 with record-breaking monthly returns. For Canadian stocks, compared to January's stellar recovery, February S&P TSX returns were somewhat modest at 3.15%, but no less welcome. It is worth noting that year-to-date, the S&P TSX leads most comparable international indices in Canadian dollars. Within Canadian market sectors, information technology outperformed, while materials closed the month slightly in the red. Similarly, U.S. stocks tracked by the S&P 500 recovered a further 3.2%. Again, a relatively modest increase compared to January, but well received by investors. This breakneck reversal in equity markets within the first 2 months of the year can be attributed to several factors. Markets were extremely oversold versus significant longer-term technical support levels, as referenced in last month's commentary. The U.S. Federal Reserve maintained its wait-and-see attitude, taking the pressure off shorter-term interest rates and reducing the risk that borrowing costs will rise further. President Trump's postponement of tariff increases on imports from China in context of what he considered to be trade talk progress. 70% of companies reporting beat earnings estimates. And computerized trading algorithms, or CTAs, switched from net short, selling, to net long, buying, increasing the upside momentum and forcing short sellers to cover their positions. On the commodity front, oil continued to push higher through February, inspired by the announcements of further cuts from OPEC and Russia and continued unrest in Venezuela. Gold, which had rallied as a hedge against market risk during the recent correction, tapered off as investors moved back into the stock market. Of notable interest, copper, which is traditionally used as a gauge for the health of the global economy, added 6.6% over the month. This significant reversal of recent declines may indicate a lower risk of a contracting global economy, at least for the short term. Moving on to fund performance, the equity fund finished the month of February up 1.35%, while its benchmark, the TSX Total Return Index, gained 3.15%. Year-to-date, the fund has gained 9.68%, while the TSX Total Return Index has added 12.16%. It is worthwhile to note that the return achieved by the equity fund was generated with a greater than 25% net cash balance and multiple hedges in place, including put options on the S&P 500 and the NASDAQ. We have adjusted these hedges higher as the stock market continues to climb. In addition, we established another hedge using the VXXB, which is an exchange-traded fund, or ETF, that increases in value when volatility in the S&P 500 options market increases. Increases in market risk and investor concern generally raise the volatility premium factored into the price of an option contract, which means that the VXXB should increase in value as more risk is factored into the stock market. Given global economic and geopolitical conditions, the fund remains defensive with a high allocation to cash and several hedges. Lowering company CEO guidance and earnings per share, EPS, predictions are giving investors cause to consider how much more upside can be expected in the short term. As we continue to navigate the mature phase of the economic cycle, we expect more volatility going forward and stand ready to deploy capital as the market pulls back and opportunities present themselves. Concerns about global growth and fair market valuations skew the outlook to the downside. Under these circumstances, we view protecting investor capital as a higher priority over outperforming the market. During the month, we took profits by trimming positions on several technology sector stocks, including Visa, OpenText Corp, and DocuSign, and in communication service stocks such as Activision and Google, as well as energy stocks such as Suncor. The income fund gained 1.19% in the month of February compared to its Financial Post Index income benchmark, which was up 0.67%. Year-to-date, the income fund has added 4.42%, while the benchmark sits positive at 3.33%. With equity trading at high multiples, building evidence that China and Europe may be already in a recession, and heightened trade and political conflict between U.S. and China, the income fund continues to take a more conservative approach. The fund remains overweight in fixed income with 55% of the portfolio invested in bonds and debentures as well as preferred shares. Company selection for the equity portion of the fund remains focused on finding dividend-paying, low-volatility stocks with a less-than-average correlation to the overall market. Cash flow is also being generated through more conservative option writing strategies, which also helps manage portfolio volatility. Exchange Income Corporation, EIF, and Egg Growth International Incorporated, AFN holdings, were trimmed as a result of strong stock performance. EIF was up 14% and AFN was up 17%. The hedged position on Estee Lauder Companies Incorporated, symbol EL, was closed out after the company reported strong sales growth in China, pushing the stock up 14.4% for the month of February. The covered call position on Danaher, symbol DHR, expired in the money, with the company reporting solid earnings growth. Overall, we continue to be patient with these markets and act on selective opportunities during the pullbacks. Moving on to our current outlook and expectations. The collective performance of our funds year to date has been accomplished while maintaining very defensive positioning overall. While the rally across US and Canadian stock markets has offered welcome relief from the 2018 correction, we still see the remaining 2019 outlook as being volatile. So far, stocks have recovered well in context of a no news is good news mindset. However, at present, upside momentum is slowing, and we are seeing the current rally in both US and Canadian markets meeting resistance from our technical analysis of the charts. Markets seldom rally in a straight line, and we have maintained an overweighting to cash along with our hedges to help offset a possible pullback. In addition, we continue to trim positions as stocks become expensive with the expectation that we can deploy cash as and when a pullback brings company valuations back to more attractive levels. Overall, we will continue to manage actively in line with our outlook and remain well prepared to put some of the cash we have on the sidelines to work on any temporary reversal.